In this lecture, we're going to go over two topics, the Lerner index and a very brief understanding of how antitrust regulators decide whether mergers should be allowed to proceed. Okay. I want to start with this graph here, which on the left shows the inverse demand curve in a market. Okay. So as usual, the inverse demand curve is downward sloping. If this is a monopoly market, that inverse demand curve that's depicted on the left is in fact the inverse demand curve that the firm faces. That is the market inverse demand, and the demand curve or inverse demand curve faced by the firm are one in the same. Okay? Even if this is the inverse demand curve for the market, we know that if the market is perfectly competitive, then the inverse demand curve faced by a firm is perfectly flat. Right? The idea is that each firm in a perfectly competitive market is a price taker. They can sell as much as they want at the prevailing market price. Right? So you go further over to the right, they can keep on selling more and more at that same price. But if they were to raise the price even a small amount above the prevailing market price, they would sell none. That is why the inverse demand curve is completely flat for firms in a perfectly competitive market. Again, I don't mean that the inverse demand curve in the market is perfectly flat, but if you look at the demand curve facing a single firm, accounting for the fact that consumers could switch to other firms, the inverse demand curve for a single firm in this market is perfectly flat. Okay, so we can actually use this intuition to derive a nice formula that has several uses. So the basic idea is that if the market is sort of close to a monopoly market, then we would expect the inverse demand curve for a firm to be relatively steep, implying that demand is somewhat inelastic, right? Or that is the demand facing a particular firm is inelastic. Right? If the market is like a perfectly competitive market, then the inverse demand curve is perfectly flat, implying that the elasticity of demand, or at least of one firm's demand, is perfectly elastic. Okay, so the elasticity of demand for the demand curve facing a single firm can be a useful piece of information for seeing how much market power that firm has. And if you go through the steps that are shown here, you're not required to know these steps, but if you go through these steps, you can see that you can derive from the profit maximization problem for a single firm this formula, which is highlighted here. And I can sort of zoom in on that formula. The formula states that price minus marginal cost over price, that's the price the firm is charging minus the marginal cost for that firm over the price, is equal to -1 over the elasticity of demand faced by that firm. So you'll notice in the denominator here, where the elasticity has a J subscript to denote that this is not the overall elasticity of demand in the market, but this is the elasticity of demand, or of the demand curve faced by firm J, so sort of the residual demand for firm J. Now, this formula is very useful because if we know any two components of it, we can figure out the third. So for example, if you knew the price that the firm charges, which you probably do because you can see what the price is in the market, and suppose that you also somehow knew the firm's marginal cost, you could back out the elasticity of demand faced by that firm. Alternatively, if you knew the price and you knew the elasticity of demand faced by the firm from some pricing experiment, you could back out the marginal cost. And that's actually something that we do quite a bit in research and in PhD programs in economics. So this is a very useful formula. However, there are some limitations of it. It's not necessarily something you want to use for merger analysis because it's actually influenced by two things. So the Lerner index, this is called, will be large if there's some combination of these two factors. If the firm has a lot of monopoly power, so a lot of market power, so it can raise price without losing all of its customers, then this index will be high. So to some extent, this index reflects the amount of concentration in the market, or the ability of the firm to raise price and still sell a large number of units. But it is also influenced by the shape of the demand curve itself. Right? If the inverse demand is relatively steep, indicating that the inverse demand curve in the market is relatively inelastic, then that would independently impact the Lerner index. So it's some combination of how concentrated the market is and how inelastic demand is in the market. but still it has a lot of uses. So how do antitrust regulators actually evaluate mergers? Okay. They look at whether they predict that the merger would lead to a small but significant and non-transitory increase in price. Okay, so it doesn't need to be a large increase in price, but it needs to be significant. What does significant mean? Well, it's a statistical term that indicates that we're relatively confident that there would indeed be a price increase, right? We have a pretty good amount of information that price would actually go up. It might not go up a lot, but it would go up. Okay, so the statistical significant part is very important in merger guidelines. Additionally, the price increase can't just be transitory. Okay? If the price were only to go up for a little while until it was predicted that some other competing firm would enter, then antitrust regulators would not block the merger. They expect price to go up, but they would then soon expect another firm to enter. So they'll only block the merger if they are pretty confident that the price will go up and it will stay high. It's not going to come down in the near term. I want to quickly distinguish between two types of mergers. One is called a horizontal merger. That's when two firms making competing products or substitute products merge with each other. So you could think of Apple, who makes iPhones, merging with Samsung, who also makes phones. Or AT&T merging with T-Mobile, which was a merger that was attempted a number of years ago. Those types of mergers are frequently blocked. Vertical mergers, where one firm is merging with an input producer. So suppose that Apple were to merge with someone who produced the screen. Well, that's not screen's not a good example because Samsung produces a screen. But let's say another screen producer, someone that doesn't actually make phones but just makes screens for smartphones. If they were to merge with an input supplier, that type of merger is not typically blocked. So why do they focus on this? Well, the reason they're trying to predict if the price is going to go up, which based on the last short video, if price were to go up after the merger, that's going to lead to a larger dead weight loss triangle, leading to larger inefficiencies in the market.